In Chapter 4, we're going to take a look at adjustments for adjusted gross income, and this is what we conventionally refer to as an above-the-line deduction, which is different than the itemized deductions we'll take a look at in a further chapter. In Learning Objective 1, we're going to take a look at student loan interest. Now, student loan interest is going to be limited to just $2,500 per year to be able to be deducted for a qualified student loan. And that qualified student loan is going to be one in which the taxpayer uses the money for qualified educational expenses for either themselves, their spouse, or a dependent during that period of time when the loan is incurred. Now, what do we mean by a qualified educational expense? So, this is going to relate to the cost of attendance at an eligible educational institution, like a college or university, and include things reasonably necessary for that attendance, something like tuition and fees, books and supplies, room and board, and then reasonable transportation. What might get excluded here would be something like entertainment or personal expenses. So if you were to attend a professional baseball game downtown while attending college, although it happened during the same semester in which you attended school, it may not be related to the education itself. It may be excluded as not an educational expense. Now, the qualified educational expense also must be paid and incurred within a reasonable time before or after the loan date. So if you took the loan within one term and the educational expense occurs within that same term, that's likely going to be a reasonable period. If the educational expense occurred either in a prior term or the following term, then that might raise an issue in terms of whether it was related to that loan or not. The expense also must occur while the student is at least half-time. So if full-time was considered 12 hours for a semester and the student was attending at least 6 hours, then they would be considered, then those expenses could be considered for a qualified student expense. And then this student loan interest, when looking at the deductibility of it, there's no discrimination between whether the course of study is for undergraduate studies, something for like a Bachelor of Arts or Bachelor of Science degree, or for graduate level, whether it be master's or doctoral level. In order to determine the deduction, the maximum deduction is going to be $2,500, but it can actually get phased out. In order to determine that, we're going to take a look at the modified AGI of the taxpayer. Now, the modified AGI is going to differ because we're including back in that student loan interest, any foreign income the taxpayer may have, as well as the deductions for tuition and fees, and deductions taken for domestic activities production. So how does this actually result as far as the phase out goes? Now, for a single filer earning below $65,000 for the year, they'll be entitled up to that full $2,500 qualified student loan interest deduction. For taxpayers earning over $80,000 in that period, they're going to have that qualified student loan interest deduction completely eliminated. Now, in between that, the $15,000 that makes that difference, the deduction for the student loan interest will phase out in terms of the percentage. Now, if it's a married filer, the same result will be reached. Only income for the joint filing below $135,000 would be the full deduction of $2,500. Income over the joint filing of $165,000, the deduction would completely be eliminated, and the percentage-wise would phase out would occur between that $30,000 difference. Now let's take a look at how that actually happens in practice. So if we look at the equation here, we'll see the formula listing preliminary deduction multiplied by our fraction is going to equal the disallowed interest. So if we were to be a married taxpayer and have $135,000 of income that's going to be considered for this for a modified AGI, we are going to have 135,000 minus 135,000, which would equal 0, divided by 30,000. So no amount would get disallowed in this situation. If we had 165,000 for our modified AGI, we would put that amount into our formula. 165,000 minus 135,000 would equal 30,000. Divided by 30,000, so 100% would be disallowed, and the deduction would be completely eliminated. If we had a modified AGI at the midpoint, say 150,000, we would insert that amount into our formula. 150,000 minus 135,000 will give us 15,000 divided by 30,000, or 50%. So 50% of the interest would be disallowed. So instead of 2,500, it would simply be 1,250 would be the allowable interest deduction to be taken. And this rationale follows similarly for single taxpayers, with 65,000 entering into the single taxpayer formula, resulting in 0 divided by 15,000, or 0% disallowed. For 80,000 would result in 15,000 divided by 15,000, or 100% disallowed, and then a midpoint would be, say, 72,500 minus 65,000 would be 7,500 divided by 15,000, or 50% of the interest disallowed, enabling the taxpayer to take 1,250 for the above the line deduction. The taxpayer, in calculating this, will input their modified AGI as well as the total interest that they're going to pay onto the student loan interest deduction worksheet, and be able to calculate the amount of the student loan interest deduction that they'll be able to take. This is a form that's going to be kept by the taxpayer and not included along with the tax filing, though. Looking at the concept check, concept check 1, in order for the interest on a student loan to qualify for the deduction, the student must be enrolled at least half-time. So if it was 12 hours for a semester to be full-time, the student must be enrolled 6 hours for that semester to be considered half-time. Under the student loan program qualified educational expense, under concept check 2, that must include what two things? That's going to be the tuition and fees. For concept check 3, the deductibility amount of student loan interest is reduced when modified AGI for those filing married or jointly reaches, and that's 135,000, and the deduction would be completely eliminated at 165,000.